Hello, good afternoon. You've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. With me is my colleague Sonal Bhutra. Sonal, good afternoon. And REITs, we've spoken about it. We know that it's come into that classification, but it's time to get more into details, right? It becomes an investable option now for PMS mutual funds and all of that.
It does, and we are seeing more interest come by from mutual funds as well since the time SEBI has classified it as an equity asset versus hybrid earlier. So we just thought let's do a deep dive on what REITs really mean as an asset class and what are the avenues for income for an investor as well. First up, the basics, of course, real estate investment trusts, a sort of a mutual fund where they acquire, own, manage or finance income generating real estate. What are the underlying here? You have offices, you have malls, you have warehouses. So whatever income they are earning comes back to the unit holders, and they are all covered under one real estate investment trust. Now, a lot changed for REITs. Since last 2 years, we've been hearing this word a lot because SEBI reclassified REITs as equities in 2025. This is in line with global practices. Now, remember, total allocation back in 2025 from mutual funds was just 23,000 crore rupees, and we are talking about an industry which has an AUM of 80 lakh crore rupees. So it's literally a drop in the ocean. They can invest up to 10% of their NAV in REITs. Currently, it's not even 1%. They are investing up to 10%, which would improve liquidity into REITs as well, which does not see a lot of institutional participation for now. Most of the investment right now is happening through, say, debt or hybrid categories in this particular asset class. In pure play equity funds, maximum allocation is not even 2% of in an AUM of the scheme. So that is what happened before it was actually classified as an equity. What do you really get from REIT as an income source? You get dividend, which is distributed by the REIT, interest income, which is the interest earned by the REIT from the entire structure. We'll of course understand it better. The capital appreciation, the properties which are the underlying, they also appreciate over time, right? So you will get that. A lot of these mutual funds do have some REIT exposure, PPFAS, AMC, you have ICICI Prudential, SBI AMC, but it is quite small as of now. So are mutual funds really looking at this piece? How do you understand REIT as an asset class? What do you really earn from it? How is it taxed? This and a lot more. To understand all of it, we have with us Nishant Agarwal, Senior Managing Partner at Ask Private Wealth, joining us now. Nishant, good afternoon. Thank you so much for joining in. Now that we've understood that, okay, these are 3 income streams or 4 income streams you would get from REIT, what are the biggest drivers of returns in a REIT? Is it the rental growth, the occupancy, asset appreciation, or acquisitions? How can one basically look at it fundamentally to understand whether they will get that growth back as their own income?
Great. Thanks for having me here. It's a very valid question and a very exciting asset classes which we are looking at in mutual funds. So let's first understand REIT. REIT are basically commercial properties, mostly residential, commercial properties which are rental yielding. And the income from this REIT comes from rental paid by the tenants. So the first source or the major source of income which any REIT gets comes from tenants paying income or the rentals for occupying that property. But there are various other levers which comes at play when an investor looks into a REIT. The rental for any commercial property or complex when you walk into not only comes from office spaces, but there are around 10% in some REITs rental, which is also coming from services which they supply to those tenants. These services can be power distribution. Some of these REITs own assets like hospitals inside them. Some of them provide services like signage, kiosk, or for parking areas. All of those adds to the rental income of the REIT. But for an investor, the growth of this rental income is also very important to see the appreciation in their investment. This growth comes from multiple factors. Think of this as any other office property. The first lever of growth in rental income comes by annual escalation. Typically in India, we see around 15% escalation over a 3-year cycle. So expect a 5% rental income, like any of the residences which we live in or the properties which we take for office. We pay 5% escalation on rental for the period we are renting the property. That's the first source of growth which comes from rental income. The second source of growth also comes from some part of property which is currently unoccupied at the time when you enter. And over a period of time, these properties and these empty spaces gets leased out and additional rental starts coming from those empty spaces. The third source of rental comes from addition of new properties. This can be from current development, which is under development and not fully leased out, or it can also happen by acquisition. So these REITs can raise more capital they can raise more debt and increase the portfolio of properties which they run, which can additionally add to income growth over a period of time. Last source of income also comes from releasing or rents or properties which are expiring on the lease contract, and then they release them based on the new rental rates which agrees in the market. So there are 4 or 5 key drivers on the rental income growth. I just summarize. First is the contracted escalation. Second is the empty space getting leased out. Third is the expiry getting released at market rates. And fourth is the acquisition of new properties. In some cases also, an additional return can be expected if the REIT itself will add or even sell some of those properties, and hence there can be some capital gains which will come inside the REIT, which eventually goes as benefit to the investors.
Point taken there, Nishant. You know, a lot of drivers in terms of returns, what come in from the REIT side, or what are the factors that drive these returns? Nishant, now what are the most important metrics that an investor actually should look at or track every quarter to judge the health of the REIT, so you know what you're aware of when you're investing here as well? And interest rates have a significant impact on REITs as well globally. Could you talk to us about both of these points?
No, so that's a very important point. In some way, REIT can be compared to a bond, and a bond which is a long-dated bond, where the sensitivity to the interest rate in the economy decides rental yield, which means that if interest rate in the economy is going up, let's say a normal FD or a bond, instead of paying 6% starts to pay 8%, typically the expectation for investors coming in will also be to generate 8% plus return from REITs and InvITs. And hence, the same investor would then, to generate 8% return without changing the rental, would have to buy the REIT at a lower price. And hence, the price of the REIT, as we say, is inversely proportional to movement on interest rate. If interest rate in the markets go up, expectation on REIT rentals go higher, the price of the REITs come lower, and vice versa, hence impacting significantly on the return expectation. So an inverse correlation between interest and REIT returns.
Okay, so it's an inverse correlation that you see between the two. You know, let's try and understand the other metrics. We spoke about occupancies aiding. We spoke about how acquisitions could aid as well. What are some of the other metrics, just following up on the question that Vinny asked as well? Is there anything else that an investor should be aware of? Maybe on the balance sheet side, you would have something on the net operating income that every quarter is reported, and hence some of the tweaks there that an investor can keep in mind.
No, absolutely. So on quarter, the metrics which an investor should look at, one is a clear distribution per unit, a term which is known as DPU. How is the growth expected in distribution per unit in the quarter and projected or guided by the management? This number is actually resulting from the underlying factors on how the rental growths are coming or occupancies are increasing. So that's one metric an investor should look at. The second metric an investor should also look at in terms of vacant capacity. Is there a lot of area which is still to be leased out or is currently lying empty? And the management of the REIT plans to kind of put it on rent and hence increase the rental collection from those units. The third point to capture for an investor is also to see what kind of debt levels are there in that REIT, because REITs are allowed to take up to 50% of debt to enhance the return for the investor. What rate is the company or the REIT borrowing at? What is the yield on the property? And hence what kind of leverage kicker can be added to the return using this borrowing. So third aspect is how much is the borrowing and at what cost is the REIT borrowing. Fourth is also about any new acquisition plan. If there are plans to kind of acquire new assets which will enhance my distribution is what is very important from a future growth perspective. Then comes the regular element of other cost in terms of managing the property, in terms of maintaining the properties, in terms of taxes, which goes away from the rental income before you arrive at distribution per unit. So those are the regular metric as well to be tracked to see what kind of interest expense, what kind of management expenses or costs are being added to the REIT. But I would think two very simple common metric to track is the growth in distribution per unit, as well as what kind of debt levels and new leasing is happening from rentals from either empty spaces or new acquisitions.
Nishant, you touched upon a point of when a REIT acquires new asset, right? So as an investor, how can they assess whether acquisition is genuinely value accretive or simply just adding scale?
Sure. No, there's a combination of both the factors. Very, very valid point. More often than not, the way to kind of look at it, what is my current distribution yield without these assets? At what price I am raising more capital, either as equity or debt in the REIT? And then the asset which I am adding will be adding net accretion in the distribution yield or my NAV. So NAV, as you know, will be the total value of the assets and number of, or the capital or number of units. You have to see the net impact of new assets being value accretive based on the acquisition price, which is 8% yield. And I'm willing to acquire something which can give me a 10% yield. Both put together, my net yield goes higher for that REIT, and that becomes a value accretive asset. Also, qualitative factors are also equally important. Sometimes you have to look at what kind of diversification I am getting, what kind of future growth potential this new assets will bring me in future, either by new development potential or new kind of tenant mix in it. All those factors also help in future appreciation in REIT prices.
Makes sense, because a lot of these REITs, the listed ones at least, are growing via acquisitions recently. So that continues to be an important thing to track when it comes to looking at their financials. A very important conversation, but we have to slip into a quick break. On the other side, we'll continue our discussion and understand more about REITs and how big of a part of your portfolio this particular asset class should be.
Welcome back to MF Corner on CNBC TV18. We still have with us Nishant Agarwal, Senior Managing Partner at Us Private Wealth. And we're discussing on REITs, investments in REITs, and how EMCs, mutual funds, are looking at it as well. Nishant, taking the conversation forward, for someone who's building a long-term portfolio today, where do REITs fit in alongside equities, fixed income, gold, physical real asset, on estate, all of that you have?
Yeah. So very honestly, REIT will not exactly fit into the allocation for neither equity nor for debt. And for reasons that debt definitely has this whole concept of capital protection and very, very low volatility on a week-on-week, day-on-day basis, and you get a defined return on what you contracted for. Equity, on the other hand, do not have a regular cash flow stream like what REIT offers of anywhere between 6 to 10%, depending on REIT to REIT. So I would place REIT somewhere as a fourth asset class, what I call as a hybrid asset class, along with equity, debt, gold, as well as REIT as the fourth asset class. This does great favor for investors' portfolio who expect regular cash flow. It is tax efficient because it is taxed like equity on capital gains. So after 1 year, you pay 12.5% long-term capital gains tax. And it gives consistent income quarter on quarter coming out from the REIT. So I would place it as a hybrid category outside of equity and debt, along with gold. In terms of allocation, because there is very strict SEBI's directive and regulations around how much distributions can happen, what kind of underdevelopment property can happen, I personally would put that as a very conservative, safe asset class. And for very conservative investor, it can easily replace anywhere between 10 to 15% of their debt portfolio. What they keep in debt mutual funds, or they keep in safe bonds or government bonds, they can do 10 to 15% of their debt portfolio into REITs. For aggressive investors, it can even go up to 25 to 30% of their portfolio, who are looking for little more longer term and consistent cash flow and improved debt return. It can go up to 25% of debt portfolio.
Okay, all right.
So to me, the allocation is moving out from debt and not necessarily from equity. Because it has very safe features and conservative features of cash flow and asset backed.
It's ironic, right? We call it a safe asset and still classify it as equity. So it is going in different directions. But you mentioned, Nishant, 6 to 10% is what the return is. Does it include the capital appreciation as well? And if yes, what is the breakup of the outflow that an investor gets? Because they need to get a statement. It is taxed differently. If you can explain the taxation differential as well to us.
Right. So I think this will be applicable more for direct investors in REIT InvITs, because in mutual funds, they don't need to care about what kind of distributions are coming from direct holding of share. But for direct investors in REIT InvITs, the payments to them come from 4 different distribution categories. The first category is what is called interest, which comes from REIT directly through their underlying SPVs. This one is taxed as the maximum marginal tax slab for the investor. So every quarter when they get distribution, every year they have to pay the tax as per their income tax slab. The second distribution which comes is from dividends. Now dividends are of two categories, that's 2 and 3. Some of the dividends from REITs can be tax exempt and some dividend from the REIT can be taxable in the hands of investor at full tax rate or marginal tax rate. This actually lot depends on how the REIT is structured and how the investment manager choose to take the tax structure under the underlying SPV. So there are two kinds of dividend. One dividend is what I call tax exempt dividend and one which is taxed at full rate. The fourth distribution which comes from REIT is coming in the form of capital return. In this, there is no taxation, but the amount which is given as capital back will be reduced from your purchasing cost. So effectively, the distribution comes anywhere between 6 to 9% in a REIT. The tax rate, depending on REIT to REIT, will fall anywhere between 15 to 25%. Over and above the 6 to 8% rate, one can expect a 4 to 5% capital appreciation in REIT properties. This appreciation, the taxability will come only at the time when you sell the REIT, like when you sell the shares. In that case, the equity taxation will apply, which is less than 1 year. If you held the REIT units, the taxes will be at short-term capital gains. If you held the REIT units for more than 1 year, the taxation applies as a long-term capital gains of 12.5%.
Okay, point taken
So
there.
4 regular distributions adding to 6 to 8 and 3 to 4% of capital gains depending on how long you hold the REIT.
Okay, point taken there, Nishant, in terms of the taxation side as well. But what are some of the biggest misconceptions retail investors have about REITs, and what are the risks that do they often underestimate and they should actually be looking at it also while investing in REITs?
That's also a very, very valid question. I think one of the challenges which we are also educating clients and people are now coming to know about is the difference between distribution coming out from the REIT as well as the yield or IRR of the REIT. What I mean by that is if there is certain REIT which pays very high distribution, it may also be coming out from capital which is getting freed up, not necessarily from the rental income or income being generated from the REIT. So one has to keep an eye on saying what is the kind of breakup of the payout which comes, and that may not necessarily be the same as the return generated on the portfolio. Second point, which is also equally important to note from a distribution of income, is the kind of risk you have on the asset. What I look at in REIT properties is the mix wide enough in terms of cities, the mix in terms of sectors, the mix in terms of tenant profiles, which will ensure that if there is one particular segment which does bad and there is vacancies which comes in the REIT, I am not very adversely impacted with that concentration. So two things: be a clear difference between what is the NAV or what is the yield versus distribution, and with what price do you buy in the market. The point I just mentioned about NAV also becomes important because there is an inherent value of the asset, but in the market it may trade because of various factors like liquidity at a premium or a discount to NAV. So all the REIT companies will be publishing in their quarterly reports what the NAV of their assets are, and then you have to take an informed call when you are entering because of various market factors. Are you paying too much of premium or buying it at a discount?
You know, when we talk about premiums and discounts, one part is we do only have listed REITs, right? And their stock price, people usually look at listed stocks because they want that appreciation there as well. REITs, they either trade at varying premiums or they look at discounts to NAV as well. How much importance should investors give to NAV, and what can cause a persistent discount despite strong operating performance? And just for the benefit of our viewers, if you can explain briefly where they can look at NAV, how do they go about analyzing that part of the business?
So this is a little more, I would say, a technical subject for a regular investor to kind of look, but a good factor of why a REIT can be traded at a premium or a discount is very similar to a stock in terms of what is the future prospect that particular REIT would have. Future prospect coming from the management, how well they are managing the asset. The future prospect can come from what is called as right of first refusal, where they can add more assets and they have visibility of what kind of future assets can be added in the REIT. Sometimes it's also about the pickup of investment activities or economic growth, and you expect that the leasing market will be very, very strong, and hence some of my empty area can be leased out, or some of these area which is coming for expiry, I have a potential to mark it up. So while NAV may have some of these factors, but a market will realize it a lot more real-time basis, and hence there can be a discount or premium to that. A lot of time, overall market sentiments and economy also may force investor for liquidity, and you may see price deviation from NAV either being at premium or at discount. And the last factor which leads to a maximum difference between premium and discount could also be at times when the sponsor or a promoter are selling large blocks of their holding for their liquidity in REITs and InvITs in the market, and hence the supply is more than the demand and the price kind of eases out or corrects. So these are some of the factors which happen, but in their quarterly reports, on their websites, all of these REITs and InvITs have very detailed disclosures around their NAVs, around their income statement, and that's the first place to go to check what is the NAV versus where we are seeing it traded in the market.
Point taken there, Nishant. It's such an important topic to understand REITs because the way it's picked up pace as well, and like we started the show. Nishant, thank you so much, for joining us this afternoon, explaining us investments in REITs, what mutual funds do, how the taxation comes in as well, what PMSs are doing. So thank you so much for that, Nishant. But with that, we're absolutely out of time in this edition of Mutual Fund Corner. Thank you so much for tuning in. Up next, we have Closing Bell to take you through the last hour of trade.